If you're part of a military family, you already know that big life changes don't always wait for your finances to catch up. That's usually when people start considering loans. While loans can be useful tools, it's important to understand what kind of loans are available, which regulations apply to you, and how they fit into your bigger financial picture. Today, we're breaking down common loan types, military lending regulations, and a few loan options designed specifically for service members. We'll also highlight why a cautious approach and guidance from a financial advisor can help you decide what's best for you. A personal loan can be structured in several different ways, including secured or unsecured. A secured loan is backed by collateral like a vehicle or savings account. Because the lender has something securing the loan, these often come with lower interest rates. An unsecured loan doesn't require collateral and is commonly used for debt consolidation or short-term expenses. Because the lender has no collateral to secure the loan, interest rates are typically higher. A personal loan can be fixed or variable rate. With a fixed rate loan, your interest rate and payment stay the same over the life of the loan. With the variable rate, the interest rate and your payment can change over time. Other common types of personal loans include installment loans, which have set monthly payments over a defined time period. These are normally used for larger expenses, and you're committing to that payment schedule for the life of the loan. Debt consolidation loans, which combine multiple balances into a single loan with one payment, and personal lines of credit, which let you borrow up to a limit, repaying some, and then borrowing again, allowing flexibility but requiring discipline. These types of personal loans are available through banks, credit unions, and online lenders, not just military-specific institutions. When lending to service members, there are two federal regulations to consider in certain situations. The Military Lending Act, or MLA, limits the military annual percentage rate, known as the MAPR, 36% on certain consumer loans. This rate includes interest and certain fees, as well as credit insurance premiums. It is important to know that MLA only applies to certain loan types and prohibits certain loan terms. It excludes home loans, home equity loans, and auto loans. It also excludes loans secured by an item you're purchasing, such as furniture or appliances. Another important regulation is the Service Members Civil Relief Act, or SCRA. SCRA applies after you're called to active duty and may cap interest rates on eligible pre-service debts if you request it and provide documentation. These regulations are designed to prevent financial strain during military service, but they don't replace careful decision-making. One of the most well-known military loan options is the VA home loan. These loans are available to eligible service members and veterans buying a primary residence. Some common features include no down payment, no private mortgage insurance, and rates which are often competitive when compared to other loan types and potentially limited closing costs. They're ideal if you plan to purchase with little upfront costs, are a first-time home buyer, or plan to stay in the home for a long time. While VA home loans support long-term housing decisions like buying a home, PCS moves often create short-term cash flow challenges. That's where PCS-related advances can help bridge the gap. During a permanent change of station, service members may be eligible for related payroll advances that help cover authorized travel and relocation expenses, such as temporary housing, vehicle transportation, or travel costs before reimbursements arrive. PCS advances are not extra pay. They're an early payment that is later balanced to reimbursements or, in some cases, payroll deductions. These loans are meant to help bridge the gap between expenses and not cover emergencies. Sometimes it's not about timing. It's about not having enough cash to cover an expense. In those situations, some service members look at loans to help manage debt or simplify repayment. If you're juggling multiple high-interest debts, a debt consolidation loan offers the opportunity to make a single payment, often at a lower interest rate. Another option some service members consider is a loan through the Thrift Savings Plan, or a TSP loan, which allows eligible participants to borrow from and repay to their TSP account with interest. While the rate is often lower than consumer debt, borrowing from your TSP can slow the growth of your retirement savings while the loan is outstanding. That trade-off is worth understanding before using retirement savings to cover short-term needs. Additionally, there are some things to consider if your TSP loan happens to enter non-pay status. While your payments are paused, interest continues to accrue. The loan term is extended for that period, and when you return to pay status, payments must restart and may be higher to keep the loan on schedule. If the loan isn't repaid within the required time frame, or if you separate from service before it's resolved, that outstanding balance is treated as a taxable distribution. That means you'll owe income taxes, and if you're under 59 and a half, a 10% early withdrawal penalty may apply. It's important to note Once a TSP loan is declared a taxable distribution, the amount becomes a permanent withdrawal from your retirement savings. It can't be paid back into your TSP like a normal loan, and the balance no longer benefits from future investment growth. This can have a lasting impact on your long-term retirement security. In true emergencies, military-specific relief organizations may be able to help. Nonprofit aid programs offer emergency financial assistance, including interest-free loans or grants in qualifying situations. Availability and eligibility depend on the situation, and these programs are meant to serve as short-term support, not ongoing financial solutions. Not all loans are created with the borrower's best interest in mind. Some loans even carry higher risk, even with military protections in place. Let's look at a few examples. Payday or cash advance loans often come with very high fees, short repayment timelines. High-cost installment loans collect interest and fees that can add up very quickly. Higher-priced or high-cost mortgages can carry less favorable terms. Balloon loans require a large payment due at the end of the loan. And interest-only loan repayments, which do not reduce the principal balance for a period of time. Even with military lending regulations in place, these loans can create long-term financial strain, especially if the terms aren't fully understood. Military life comes with unique financial circumstances and unique protections. Before taking on any loan, it helps to slow down, review the details, and consult with a financial advisor to determine the best option that meets your needs. If you found this video helpful, make sure to subscribe for more military financial planning tips.